Right, welcome everybody to Midas Investing Live. Happy Sunday afternoon. Hope you guys all had a pretty good week. As you guys can probably see, got a mic arm finally for myself. So that my mic's now right in front of my face. So that means sound settings have been changed around a little bit. So let me know if it sounds a little too weird. I'm gonna have to probably change some of the settings around later this week because I actually just got this only yesterday installed. So it probably sounds a little bit louder than usual, but I don't know. Maybe I'm gonna change that around after the show or something like that. Hey Jeff, how's it going? See you here right and ready. Pretty excited to. It sounds quieter. Interesting. Yeah, because I was kind of adjusting some of the settings around. I'm not sure exactly what to do with it, but I didn't really get a huge chance to check it. I checked it a little bit, but there's like kind of checking it in the recording versus checking it the way it comes out on stream is a little bit different. So it kind of takes a little bit more effort to check every direction. But if it sounds like it needs to be upped the volume, I can do that. So let me know. Let me actually just go ahead and push it up a little bit. Anyway, so I'm pretty excited to share the presentation I have with you guys for this week. Sounds good. Okay. Right off the bat, we'll look a little bit at the portfolio. There wasn't too much changes to the portfolio this week. It was very, very quiet, all considered. Just kind of shifting things around a little bit in terms of the cash levels and my overall index levels. And then I really just spent a lot of the week doing the research for this show, which I think actually has some pretty good results. So you'll definitely see what exactly we're talking about. So obviously we're going to be talking about oil. Obviously I put in the thumbnail Mr. Buffett's picture, but unfortunately I will just come out and say it. We're not really going to be talking about Occidental petroleum too much, but we will be talking about kind of oil in general. Congrats on Interfor and FG. Did you see that AEL offer the other day? I did. Yeah, very, very interesting to see that pop on AEL. We were talking about it in the Discord a little bit. I couldn't remember if you were part of the Discord or not. I thought maybe you weren't part of it, but people were kind of asking if you what your name was in there. Some people were wanting to kind of tag you after the news had come out. But yeah, and then FG has basically been carried up all week after that news. So yeah, it's been a very, very good week for our portfolio. If you come down to the returns, you can see, yeah, smalls in general had a very, very good week relative to the index. And we're definitely starting to make up some of the lost gains, or basically still in line with the index for the year to date. Or not the index, the small cap index, still trailing behind the S&P, but working to get up on that. I can see, yeah, FG is definitely now into kind of like clear gains territory. I mark these as green or red once they're positive 25% or negative 25%. So you can see in total return terms, FG is now solidly into serious gains territory. Yeah, not in the Discord. Yeah, I thought so. That's kind of what I thought. But yeah, there was plenty of people congratulating you in spirit in the Discord. So yeah, but yeah, hey, you're here pretty much every week, so no problem with that. You don't have to be part of the Discord to be part of the community. It's just definitely a lot of people are. But yeah, like I said, there was a lot of congratulations going your way as a result of that. So I guess I'll just share it with you directly. But yeah. So yeah, very, very good returns overall this week. We'll take a quick look at the valuation dashboard. There wasn't necessarily too much changes with it other than the movements up that we were talking about. Smith&Wesson kind of stayed a little bit in the same territory from where it was last week, but Interfor as well as FG both had pretty solid weeks. InMode also kind of staying in basically the same category. So if we're judging strictly on the 5 companies that I was talking about last week as ones in the short term, we've already gotten a little bit of a reaction from a couple of them. But yeah, 3 out of 5 still no real major moves. In fact, it looks like Hibbett actually came down, I think, on net overall this week, maybe about 5% more or something like that. I wasn't paying super close attention to Hibbett. But beyond that, I was really just kind of working behind the scenes to get my Smith & Wesson valuation in order, which is the video that I am planning for this week. So definitely keep an eye out for that. I haven't actually filmed it yet, but I was putting together the model for it. But yeah, so beyond just working on the Smith & Wesson valuation, everything I did this week was pretty much just focused on oil. You guys had definitely been making enough requests over the last several weeks about oil and the energy markets in general. And we've been putting forward many tickers, such as Occidental Petroleum had definitely gotten mentioned several times whenever we were looking at tickers, along with a few of the other oil majors, as well as a few other more minor players that people have suggested to me both publicly and privately. eventually was just kind of making me say, you know what, it's time to maybe start taking a look at the actual oil situation. But to do that, I really wanted to put together a better model for how to actually think about oil prices themselves. If you're going to make projections for oil companies, you need to be able to have some sort of forward thinking perspective about where the oil prices are actually going to go over the decade that you're trying to project for. And then likewise with oil, most of the oil companies, or at least I would say at least a solid half of them, also have their foot in the natural gas space. So if you're going to have a perspective on that, you should probably have a natural gas pricing perspective as well. I didn't actually put together a model for natural gas yet here this week, but I do think that the model I put together for crude oil will eventually be probably like an input price into natural gas itself. They're very closely related. In fact, I kind of wanted to do crude oil so that I could do this process on a few other commodities as well, such as like gold, because crude oil also is a major input into the gold mining process as well. So I figured getting a crude oil estimate would be useful first, because I could probably use it in itself to actually make projections for other commodities down the road, such as, like I said, perhaps gold, silver. Lumber is one that we've already done a lot of coverage here on the channel. And I will say that even in the valuations I did for lumber, the projections for the lumber price itself that I had made were basically relatively simple forward moving projections based off of the general momentum of lumber over the several last trailing decades. So it basically just assumed that the demand for lumber is likely to continue because of the fact that we just don't have another material to replace it for. Well, that isn't exactly the case with oil, as obviously what with the advent of electric vehicles and stuff like that, there is a huge discussion about just how much of the demand of oil is going to disappear over time. So coming over to this spreadsheet, this is my my crude oil spreadsheet I put together. There's a whole bunch of information on here, and we'll kind of go through a whole bunch of the pieces of it. Right off the bat, we'll take a look at kind of oil prices. Hold on just a second. Let me over here, move myself into the, I'll go over here to this corner. But anyway, so here's oil prices going back to approximately 1971, pretty much when the US dollar started in a free floating form. So that's pretty much the entire time that you can get oil prices, generally speaking, in any sort of realistic fashion. In fact, it's arguable that really going back to 1978, when oil prices themselves were disconnected from a spot pricing against the dollar, but that would actually be a better time frame. But I went all the way back to 1971 itself. Jeff, one thing I thought was really amazing for crude, we drained a good chunk of the SPR, the emergency reserves, at $95 a barrel and refilled it at 65. If we pull that off, it's a huge win. Yeah, there's definitely some strategic benefit that can be had out of that if they manage to do it correctly. Of course, that is a little bit dependent on them being able to actually actually act on that and actually make sure that they do fill up the reserves, because sometimes their timing is good and sometimes their timing is bad. But so far it looks like that actually could end up being a relatively good move for them at the end of the day. So taking a look at the lumber prices here, the blue line is the month end lumber price for each of these periods. Like I said, it's a monthly chart going back about, what is that, 50 years or so, 53 years. The red line is the rolling 10-year average of the oil prices. So you can see that the averages, the 10-year average moved all the way up from 1971 till pretty much the end of the 80s. Then near the end of the 80s, it actually dripped all the way downward till around the end of the 90s. And then at that point, it started to tip back upward in terms of the 10-year average, all reaching a high point at 2015. And then it's been kind of moving somewhat downward ever since then. Obviously, that's just the 10-year average. So you can see there's wide variations around it, but the general point of it is to show that even during a period like 1980 through 2000, which was a large period in which large amounts of the global economy was coming online, and therefore had large demand for energy, you would think that maybe energy prices would be skyrocketing during this time frame. But I would also point out that this is also a period of relative fiscal responsibility in terms of the reserve currency government here in the United States, as well as there was some deflationary pressure to the bringing on of other global economies or other international economies onto the global economy itself, because that brings a larger amount of workforces onto the global economy. So while there was a large demand for oil during this period, there was also a large amount of extra productive efficiencies being brought on during this period. So that's one of the reasons that you can see a long period of time where oil prices don't necessarily go up, even though you might necessarily think that they would go up during that time frame. Then following after that, we see a period from 2000 all the way through around 2015, which is when it really crashed, but obviously it reached a peak point here in 2008, at least in terms of these month-end prices. So a nice 10-year period where it really ripped, more than 10xing during this time frame, from the trough to the peak, and then obviously came all the way back down to a point where from the previous trough to the next trough, it had basically only like doubled to tripled, 2.5 times, even though it had gone from a 10x. So 10x down to a 2.5x or so. So huge variability within this. Now the yellow line is the 10-year rolling CAGR of the 10-year average itself. So you can see a little bit of more of a smoothness in terms of like what types of percentages you might be able to see. The percentages here on the right hand chart. You might ignore this earlier bump up since it was the period when the price was initially adjusting to being in a free floating market based scenario. So the general kind of idea you would say is if the future was to repeat the past, you might see a possibly a 10-year period as much as -3% per year on a compounded basis, or possibly as much as 13% per year on a compounded basis. Just take a sort of midpoint between the two and you get maybe about 5% per year. I've actually come over to the this data table over here for you can see the actual statistics for it. The third quartile, therefore the 75th percentile, is about a 13% CAGR. The first quartile, the 25th percentile, is about a 0% CAGR, with the median being about a 6.2% and the average being a 6.9% in terms of those changes. Now, moving on from just prices, this is just price information. I also went and took a look at the supply versus demand. Now it's on the left-hand chart here. I specifically have barrels per year per capita, barrels per year per capita for each of the metrics of oil consumption, which is the red area, and oil production, which is the blue area. So both of those are in terms of that. So you can see the oil consumption itself has came down a little bit in the earlier 80s during not coincidentally enough, the period when we had quantitative tightening. And then during the period of the kind of mid 90s into the early 2000s, you can see a lot of the consumption was really starting to rise back up, though not necessarily at a very fast pace. This is not a metric that moves very fast because, again, we've adjusted for population growth being a huge factor therein. Now you can see is that production itself has been rather laggard compared to the actual consumption levels, which I think is one of the reasons that you can see some periods of time where the prices really started to shoot up, is because obviously if consumption is moving up faster than production, at some point the supply and demand balance gets too far shot to one direction, and you're going to see large price movements shoot up. These lines, the blue line and the red line, are on the right axis, and they're the rolling CAGR of these, the production and the consumption metrics. Now, the thing that's a little bit difficult is that the 0% line is at this point here, and there isn't a bar here. So it's a little bit difficult to see the points in time when the CAGR is above 0. But you can kind of see it right here, that the production CAGR was only above 0 for a few years, really, in the kind of early to mid 2000s, whereas the consumption CAGR has been above 0 since about 2000. Through about 2015 or so, minus 1 or 2 years where it dipped below it. So in general, yeah, throughout the 2000s, you can see consumption was growing much faster than the overall production levels. So moving on from this, and yeah, I do in fact not have data going back up to the most recent years, unfortunately, for some of this. Moving on to production in terms of like who are the major producers. I went and I got a lot of information for this. The area in the background is the total production. Now on this previous chart, we had production adjusted per capita. I removed the per capita aspect on this chart. This is just the total global production of barrels per year on the background. And then the lines backed up against it is the top 5 producers globally and their percentage of that total global production. So you can see the USA, Russia, Saudi Arabia, Iraq, and China are the top 5 global producers as of 2021 numbers. And you can see where they currently are within it. Here you can see USA's production levels had declined from the mid 80s all the way down to the mid 2000s. And then this is when the shale revolution really started to take off. And then we became a top global producer once again. You can see other countries as well. Russia, with the collapse of the Soviet Union, they were at much higher levels of production. Unfortunately, I don't have the data for the Soviet Union, but I'm pretty sure they would have been at pretty high levels for much of that time frame. But you can see that after the Soviet Union collapsed, they had dropped pretty precipitously for a long period of time while they were still readjusting to a market economy. And then eventually they managed to gain solid footing in terms of their production levels again. Other people it's worth paying attention to, like Saudi Arabia. You can see Saudi Arabia has been remarkably stable ever since the mid 80s. They had a lot of turbulence in the the 70s and the 80s, while a lot of OPEC situations were going on, but you can see that ever since then, it's actually been remarkably stable. So just kind of general background information. I think it's important to have an idea of who the major producers were. You could have included the top 10 producers. I think, like, for example, number 6 is Canada, if I'm not mistaken. Number 7, I think the UAE is in there, maybe at number 7 or number 8. There's Brazil's in there, I think, in the top 10 as well. So there's other countries to pay attention to as well, but I just included the top 5 here. Okay, now moving on from this, I did try to a few different methods for how to make predictions for the oil prices for the next 10 years. I tried looking at a bunch of economic data, a bunch of economic series to build a regression model. Now, specifically, the complicated part is trying to predict prices 10 years out. You can find lots of economic data points that correlate well with oil prices here and now, but the difficult part is to find an economic data point where the change in that economic data point in, say, like the 90s actually makes a strong correlation with decent explanatory power towards the change in oil prices in, say, the 2000s. That's the difficult part of the process that I went through this week. And I gotta say, I tried like 40 or 50 different economic data points across a variety of different time periods. I tried it against the spot oil price. I tried it against the 10-year rolling average. I tried it a variety of different methods and a variety of different spacings. And most of the metrics I tried didn't really work. And just so you have an idea of the type of stuff I was trying, I tried population growth. I tried the production numbers. I tried the production numbers adjusted by population growth. I tried money supply numbers. I tried economic growth figures like GDP, both of the United States and global GDP. I tried consumption levels. I tried density levels by population. I tried savings rates. I tried a variety of metrics. But at the end of the day, the one metric that I found that had decent explanatory power towards a forward oil price, again, making a prediction based off of the change of this economic indicator to make a prediction of what the oil price changes is going to be in the next decade. The specific metric that I ended up falling on ended up being the city urbanization rate, specifically the global city urbanization rate, which is a percentage of the population living in cities versus the percentage of population not living in the cities. So I built a model, a regression model, trying to predict the oil prices based on that. And then I relied on the historic data of the city urbanization rates, as well as the historic oil prices to make predictions for as much of the historic time frame as I could, so that I could compare my prediction against the actual oil prices that then did occur during those time frames. So now moving over to that model, this is actually the picture of the model. Now, it's not monthly prices. We have it yearly prices. So here, this blue line is effectively the same blue line we were just looking at. It's the oil prices, but it's on a yearly basis rather than a monthly basis. So that's the reason it looks different. And so what you can see here is, like, this is where the present is at the end of 2022. And this is roughly the beginning of the 1990s. And here's just more historic time frame, which I had. So this is the point in which I started making the prediction. And you can see the red line is the effective predicted price for the oil period. Now, it is a statistical measure, which means it's only expected to have so much accuracy, which is why that there's this beige, yellowish band around it, which represents 2 standard errors away from this predicted value. So the idea is that as long as the line is within the beige period, you could actually consider it a reasonable prediction according to this metric. Again, we're trying to predict oil prices 10 years out, so you can only predict with so much accuracy. Now, given that it is 2 standard errors away from the predicted value, it would be considered a reasonably accurate prediction, assuming no more than 1 data point, given this many data points in the predicted series. No more than 1 data point fell outside of the series. And so I'll point out that, in fact, my model actually ends up with 3 data points outside the series. So it isn't actually necessarily that great of a model. And as you can see, it doesn't capture a lot of the higher, more volatile points up on the upside here. It also doesn't miss some of the negative points to the downside either. So even though we do have a predicted range for the future, the next 10 years, I would say that it does come with a massive grain of salt, because it doesn't manage to actually capture all of the data points within the predicted model. Now, this isn't the only thing I did. Now, you might be looking at this being like, doesn't sound super great. How do the trend lines look similar? Well, I mean, you can see it right here. It's so-so is what I would say. So it looks like it did a pretty good job during the 90s, but then during the early 2000s, it looked like it captured a lot of the same movement, but it didn't manage to capture a lot of the same volatility. Then it managed to kind of miss out on a lot of the high points in the early 2000s, but at the same time, that means it basically kind of moved through this, because again, this is based off of city urbanization rate. So it's basically saying that based off of the city urbanization levels at this point in time, it believes the oil price would be at this height at this point in time. And so based off of the city urbanizations at this point in time, it believes that the oil prices would be here at this point in time. And the logic behind it is that the more people that move into cities is going to create more people being born in the cities, and more people being born in the cities is going to lead to more energy being needed over time. Mr. Beast is here. How's it going? I figured you might like this this presentation. But anyway, as I was just saying, it's only so-so. I would consider this a successful model if only one data point had fallen outside of it, but considering 3 are outside of it, it's not necessarily super predictive. But nonetheless, the predicted value for 2031, or approximately 10 years or so from now, is about $93, $94 per barrel for the WTI oil price, with a predicted range of 2 standard errors of anywhere from 134, maybe on the upside, to possibly $53, $54 a barrel on the downside. So a pretty wide range of a predicted value there. Pedro, so oil is going down in the short term according to that model. Good thing to point out. One thing I will say is that yes, because you do point out that the predicted value seems to show that oil will go down in the short run. I will say that that also can be taken with a grain of salt. This value that it's being predicted right here is being done based off of the city urbanization rates that were happening 10 years prior to that. So it's not necessarily that it's for sure going to come down at this point in time. It's just saying that the model at this point in time predicted that this is what the price was going to be. So the actual trend from this point to this point to this point to this point isn't really necessarily what matters here. It's more about just the general location of the oil price based off of 10 years forward. So really, because like I'm more concerned with the end of the chart than I am the midpoints of the chart. But you could also, for example, maybe take an average of all of these points that I have on the line here, and you could maybe just take an average of all of those points and say that that's maybe a decent predicted value. So while yes, it does show a little bit of a dip here, I'm not necessarily specifically predicting that I think oil prices are going to go down in the short run. I'm more concerned with the long run of this model. The long run of this model is really kind of the general point of it. The thing about oil is that it's under strict control until a country wants to undercut and make more money. EVs could really hurt oil, but they could just change production volume. Makes it hard to figure out. Yeah, it's very, very difficult. That's definitely one of the reasons why, even though my model isn't going to be taking the differences in production from different countries into account, I thought it was super important to at least cover that topic, because if you're going to be invested in oil, you should probably be paying attention to the government actions of these countries. It's going to be pretty important to what's going on around you. You definitely want to be paying attention to what's going on with the OPEC countries. So moving past this was my regression model, my statistical based model. I did also build a more fundamentally based model, something a little bit similar to the types of models I do for DCS, where I just take a bunch of economic data and then make predictions in general based off of my own kind of subjective expectations about these things, and also taking into account maybe some of the statistical information related to some of these factors. So I took world populations, as well as USD M2, the barrels produced per capita that we were talking about, and the reserves per capita, as well as the total combined share of those top 5 nations. That was something that did matter to me, because like you were talking about, the more control there is in the top nations that can have oil power, the more pricing power that those nations will have. So I did want to take that into account for my more fundamentally based model. Barrels per year per capita consumed, as well as net depletion, which is my estimate of effectively the amount of barrels per capita that is being consumed more than the barrels being produced. So basically on a yearly basis, how much more is being consumed on a net basis. So taking kind of all those factors into account, I wanted to kind of build my own kind of more fundamentally based prediction of oil prices. And based off of that, the prediction I ended up with for 10 years from now is $93.16 per barrel. Now I'll come back over to the regression model, because you may notice those are remarkably close prices. That's kind of just a total coincidence, kind of a happy, lucky coincidence that my regression model and my fundamental model both ended up with about $93 per barrel. I don't want to say it's a sign, but at the same time, I mean, it's kind of cool that I ended up using two totally different methods to come up with basically the same predicted price for 10 years from now. I also took a look at, for example, just like what is a more momentum driven kind of prediction for oil prices, taking a look at like I was saying before, what is the kind of more typical range of movements over time and kind of like the more typical movements we typically see. If we saw typical movements based off of the normal spot oil price, you might expect maybe about $105 per barrel. And if you saw typical movements surrounding the 10-year rolling average, you might see about $117, $118 a barrel. So all of them, kind of within somewhat of a similar range. They all fall kind of within this kind of range of pricing right here in terms of those estimates. But all of this is now still just me looking at the data myself, my own subjective views on the data, as well as my own statistical analysis and using of economic data to try to make statistical models. So what about other people's estimates? That there's lots of economists out there that make their own predictions for oil prices. I also went to go take a look at a variety of other places. Now there's the International Energy Agency, which is one of the biggest agencies from which you can get a lot of data about the energy markets. In fact, I'd highly recommend people, if you're interested in energy markets, you go and find the IEA 2023 analysis PDF. You can find it. It's free online. Just basically just Google that and you'll be able to find it. It's this big 127 page PDF. And a lot of the data that I was using in my model came from this document. I found it, some of the data came from other places too, but probably more than half of the demand figures, the consumption figures, all that stuff, like probably more than half the data that I found came from this one document. So very, very useful document. And they themselves in this document make their own price predictions about where they think oil prices are going. So I included those here. They have a bull case, a base case, and a bear case. Now their prediction is based off of specifically 2028. And I got a variety of predictions from a variety of different sources, and a lot of them use the predictions at different points of time, whether it's 2026, 2028, or some of them did 2032. So basically I took whatever their estimate was and I adjusted it for the market-based estimate of inflation to bring the price estimate to 2032 so I could have a similar time frame estimate. Unless they themselves had their own estimate of inflation as a prediction as well, which some of them did, and then I relied on that estimate instead. Are you following Cuppy, Mr. Beast? He started that Sprott uranium play, as far as I know. He's long oil too. Yeah, and don't worry about uranium, my guy. I've been hearing you talk about uranium, and I've definitely been thinking about it a little bit. Don't worry. It'll get a little bit of mention here in a minute. Once we finish talking about oil prices specifically, I am going to talk about oil companies. We're definitely going to be talking about some oil companies here in a little bit. I've been kind of trying to speed through all of this as fast as we can so we can get to the juicy stuff, because the juicy stuff is screening companies, right? So we'll definitely be taking a look at that. But the point is when I was screening for energy companies, I definitely came across a few uranium companies, a few coal companies, a few other random companies that didn't quite fit into the crude and natural gas category. So I didn't just get rid of those tickers. I did set them aside because I was like, ooh, uranium. We're gonna maybe take a look at that too. So we'll maybe take a look at that at some point. Anyway, the IEA bull case, base case, and bear case assumptions for 2028 are $98 a barrel, $86 a barrel, and $67 a barrel. So I forwarded those prices to 2032 based off of inflation expectations, and we get to 108, 94, 67. IMF has their own estimate of $53 per barrel for 2026. The World Bank has their own estimate for 2032 of $69 per barrel. The National Energy Board of Canada has a base case estimate of $70 a barrel for 2032 with a bear case estimate of $51 a barrel. They don't even have a bull case estimate for them. McKinsey likewise also doesn't have a bull case estimate in theirs, but they have a base case estimate of $75 a barrel and a bear case estimate of $65 a barrel. And Deloitte of Deloitte & Touche accounting firm has $85 a barrel. So you can see there's a pretty wide range of estimates as far as where people think oil prices are going. In general, I would say that their estimates are more on the lower end of the band, whereas my estimates were generally more towards the upper end of the band, but most of their estimates also kind of fell generally within this band, with maybe like only one or two falling a little bit below it. So nothing too crazy in terms of that.
So what I chose to do in terms of like what I'm going to be doing in terms of how am I going to think about oil prices, I have my regression model, I have the fundamental model, I have all of these estimates. I decided I wanted to use basically a little bit of everything. So I built a kind of a composite estimate of 20% of just relying on the current oil price as well as current moving averages of oil prices, 20% based off of the estimates that come from the analysts and whatnot, 20% from my regression model, 20% from the fundamental based model, and then 20% based off of historic price changes, and then forward estimates based off of that. And then I built a distribution of prices based around that, building it up to about 1,000 different options, and then based off of those, the distribution of those percentages and the estimates that we saw within it, this is the distribution of oil prices that I ended up with. You can see it kind of moves by about chunks of 10 from 65 up to 140. So you can see the general majority of them fall between $85 and $95. You can see the different distributions of the 10th percent, 90th percentiles, 80th percentile, 70th percentile, the median, up and down the range right here. My revenue DCF template that I use typically has 20% on either side of the bull case and the bear case assumptions, with 60% in the center. Technically, I can have larger percentages on the outer edges, but it has to be at least 20% on the outer edges for the model to work, based off of just the way that the formulas work. So basically, I chose to align that with the 80th percentile and the 20th percentiles, and then make the median approximately the 60th percentile, which makes the expected value for 2032 prices based off of all these estimates that I've talked about here over the last 30 minutes, means the estimate is about $84 a barrel. So that's my prediction for oil prices 10 years from now, is that this is the kind of distribution of potential prices 10 years from now of oil prices. But in general, I would expect about $84 a barrel. So with that, we can come over to take a look at what else I did. Like I said, the point of this was to be able to take a look at energy companies, right? So I did come over to Ticker Terminal and made a bit of a general screen across not all the companies globally, but USA companies, Canada, Australia, Great Britain, as well as Swiss and Netherlands. Specifically was trying to target to make sure I got certain oil majors into the grouping. But then also in general, I just wanted to kind of get most of the energy companies across the developed markets in legal systems that I'm particularly a fan of. But the point is that total sample was about 110 companies, pretty wide range of companies. And then as I was kind of hinting at a little bit earlier, there were some companies in this mix that didn't actually fit in amongst the crude and natural gas selection group. There was a couple of uranium companies, a few coal companies, a few other random things just kind of in the mix. So I did kind of like hand go through them and make sure that the ones that made through. Did UNTC make it into the screen? I'm not sure if it made it into that initial screen or not, but I did do follow-up screenings as well, as I was just about to say. So I will say is that various people's favorite companies maybe didn't make the end results of where we're going with this. Just be clear of that, because kind of the point was to try to get down to a relatively select group of companies based off of some of the oil price information that I use as well. So I wasn't just screening based off of the fundamentals that were on ticker. We were also going to be using some statistical information to make this point as well. So the point is I did end up with about 100 companies here, and I'm not sure if UNTC is in the mix here or not, because it's not sorted based off of alphabetics right now, so I can't necessarily tell you right off the bat. But then I did also screen out the top 25% most expensive based off of PE ratios, as well as EV to EBIT ratios, and then also the top 25 most over levered in terms of liabilities relative to assets as well. So that's what I was saying, is like we screened out basically some of the worst companies as I was defining it, the more expensive, as well as the ones with the most liabilities. That left us with like about 80 to 90 companies. And then at that point, 80 to 90 companies, I then did a little bit of a statistical analysis where I took the oil price that we currently have, the current oil price, which is around $70 a barrel. And then I took oil prices for the last 10 years, and I compared the price returns for all of these companies against the price returns of oil, and then regressed those price returns against the prices of oil, and then made a prediction of what I think the price of the stock should be based off of the current price of oil. This is a method that I learned from watching Aswath Damodaran's lectures. He talks a lot about using commodity prices and regressions against them for for analysis. He in particular also likes using revenues as a regression tool for building up valuations. But I use just the stock prices themselves to kind of get an idea. It's like just how over or underpriced are some of these companies against oil itself. And so what we did is we built a little bit of a special screen based around that information. So at the end of the day, the end companies that had the strongest correlations against oil were the ones that I ended up keeping in my selected group, which means we ended up with this specific 21 tickers right here. And so, yeah, I'm sorry, UNTC didn't unfortunately make that particular grouping right here. But like I said, it's only 21 companies that made this particular list. I can see some major names that made the list, like Exxon, Occidental, Enterprise Products that we've talked about on the channel before, Shell's on the list, Suncor's on the list, Ovinative I've talked about on the channel a little bit before, Marathon's on the list, Conoco, Chevron. So some of these bigger names are on the list over here, but you can see there's already a bunch of markings on here, so we'll definitely get to talk about some of that. Wow, most of the bigs made it. Yeah, that's because, like I said, a lot of them actually had relatively good correlations against oil. So like I said, some good companies maybe didn't make this list, possibly just because they didn't regress very well against oil. So the thing is, like, this isn't necessarily to say that these are the best companies in the whole energy markets. These are the ones against which I could use oil to make a prediction about their pricing. So that's something that has to be understood. It's like just because a company doesn't make this list doesn't mean that they're not necessarily a good company. And just because a company does make this list doesn't mean that they also are necessarily a super great company either. The point is that what it just gives me one extra variable with which to check their pricing. And specifically, we have that right here in this column. So I have the over or under pricing relative to oil. If it's a positive number, that indicates upside to the oil price, which there's only actually, I believe, 3 companies on this list that actually have upside relative to the oil price based off of this. However, you can also consider it against the averages or the medians. I have the medians of each of these figures down here. So the median underpricing relative to oil is -3%. And so, there's some companies that are better or worse relative to that. Then I also have the median of the multiples. So we have median PE ratio 9.5, median EV to EBIT 7.4, median dividend yield 5.2%, median liabilities to assets 43%, and as well as we also have the trailing 12 months revenues, as well as the analysts' estimates of the forward next 2 years of revenue estimates. And then I took a COGR of the revenue estimates for the 2 years. So I wanted to get an estimate of, okay, how much growth is estimated for the next years. So basically what I wanted to do is I wanted to take the companies that had the strongest correlation of oil, and then I wanted to then select for the companies that I thought were the cheapest in terms of multiple, cheapest in terms of oil, have the lowest liabilities, and also are expecting reasonable growth or at least moderate declines relative to their peers. It's a little bit of a busy chart, and the green markings mark companies that are better than the median for each of those metrics. All the columns that are green are the ones that matter to me. And then if they got a green point on their cell, then they also got a point on this column right here, to which we then ordered all the companies by the total points given. So which is why you can see the markings over here, because they're indicating the strongest companies. So there's only 2 companies that ended up with 5 points, Baytex Energy and Cord Energy. Then there was 3 companies with 4 points, Crescent Point Energy, Whitecap Resources, and Parex Resources. I will particularly point out Parex Resources because Parex Resources probably wouldn't have made it onto this list if it wasn't for the fact that over the last couple weeks, a viewer on the channel and a member in the Discord had particularly been bugging me to take a look at Parex Resources. The reason it wouldn't have made the list probably is because I was initially also only including companies above a couple billion market cap, because that was one of the other things that I did when I initially screened off of ticker, just because I wanted to limit the total amount of companies that I was looking at, since I knew I was going to have to kind of comb through them manually. So that one made the list when it may have otherwise not made the list, but it's kind of interesting and nice that it did, because it did still score 4 points relative to the peers. So that's pretty good. And then all the other ones down here are the ones that still scored 3 points. And then I have Golar particularly noted as well, because I wanted to in particular note the companies that did have a positive underpricing relative to oil, which are these 3 companies, as well as those 3 companies all have positive forward revenue expectations over the next 2 years, which I thought was very interesting. because most of these companies you'll see have revenue declines expected because they're energy companies and energy prices have been coming down. So seeing any company on this list that has a forward revenue growth expectation was just kind of interesting, worth kind of maybe looking into in particular. So like I said, this chart is definitely still a little bit busy. So why don't we come over to a chart that's also very busy, but maybe makes it easier to look at once you sort of understand what's going on. This is basically the same chart we were looking at, but kind of put into a visual format. It's a little bit tricky to look at because each company on this list has 3 points. I'll point that out, like right here, you can see WCP, but each of the 3 points are all on the same line. That's something you'll see here, is that basically it gives you an idea of where each of the 3 metrics are relative to each other. And then you can see where each of those metrics are relative to the rest of the group. Specifically, we have the mean forward PE for the next 12 months on the left-hand chart. And then we have liabilities as a percentage of assets on the right-hand chart. And then the revenue CAGR is also on the right-hand chart, but I inverted it so that the higher the number, the worse, and the lower the number, the better. So that for all 3 of these metrics, you want it to be lower. You want all 3 metrics to be lower. And on the x-axis is the underpricing relative to oil. So you want it to be lower and to the right. The being in this corner is where you want the companies to be. And so specifically, you can see Parex Resources looks pretty good. Golar LNG looks pretty good. Whitecap looks pretty good. Oxy, at first glance, looks like it could maybe be sort of good, but what I would point out is that the blue dot is the general pricing, the forward PE ratio. And so it ends up not looking super good once you take that into account. In many ways, I would say the blue dot being lowest is probably most important, with the gold dot being lowest being kind of second important, and then the red dot being lowest kind of being third important. So it's like Oxy doesn't really look that good because it kind of looks a little bit expensive in terms of its general pricing and its liabilities. But then we have Baytex, which looks pretty all right. Cord is kind of hard to see right here, but those 2 points are right there, with the third being up here, which is pretty okay. And then you can make arguments for maybe a few more of these other ones, but that's the point where it starts to become a little bit messy. These ones, in my opinion, definitely look the most obviously underpriced. Okay, so that's my quick overview of the kind of energy markets and energy pricing. And my kind of general recommendations is that if anybody was interested in looking at energy companies, these might be the companies to take a look at, with a definite focus on the ones near the top of the list. And don't worry, I already did some of these companies for you guys. I went ahead and did a basic valuation for Baytex Energy as well as Cord Energy, since those were both of the ones that scored 5 points, as well as I did do Parex Resources as well, since it scored 4 points. And like I said, there was a viewer of the channel that was in particular asking me to do so a lot over the last few weeks. And there was other aspects as well, like it was being highly shorted, it had good insider coverage, and it also, like I said, had the positive revenue expectations. So there was a lot of specific criteria to that one that made me be like, that actually could be an interesting company to look at. So let's come over to the value dashboard, to the secondary page, because that's where we'll find it. We'll sort by alphabet so we can actually take a look at them. And then here they are. We have Baytex Energy, Parex Resources, as well as Cord Energy. Here, let me actually drag my head back down over here. You can see that they vary pretty significantly in terms of the actual valuation, how it ended up. One of them appears to be pretty significantly undervalued. The Baytex Energy, which was one of the ones that scored 5 points, it does in fact look pretty significantly undervalued to me. It's worth noting that this valuation is dependent on a decent amount of growth, but not a ridiculous amount of growth. But nonetheless, I'm using my composite estimate of oil prices for my estimates. As I said, we're basically relying on the 80th percentile and the 20th percentile for my base and bear case assumptions for oil prices in the model. And then I basically just rely on whatever forward guidance for production levels that the company has effectively given in building that valuation. For both Baytex and Cord, they didn't really give necessarily super robust information in terms of like the growth prospects that they expect for the future. So I mostly relied on kind of averages of some of the historical production levels that they've had over the last few years. So in particular for Cord, you'll see that that's the one that appears to be overvalued. I will say that this is the one that seemed to give me the least useful information in terms of making predictions for it. So it's possible that I'm just way underestimating the amounts of production that they will be able to sustain in the future there. It's the one that I have as the most overvalued, and it's also the one I have the least confidence in the actual value that I came up with. Herrick's resources, I actually have the most confidence in the specific predictions that I made for it in terms of production levels, because they actually provided the most information. But as you can see, it's kind of middle of the pack. It appears to be a little bit undervalued with decent expected returns. But I'll point out that while this is a Canadian company, it does basically all of their operations in Colombia. So it's effectively just a Colombian energy company. So a lot of the expected returns, the 16% expected returns, almost 4% of that expected returns just comes from the geographic assignment of equity risk premium that I have on that company. So a huge amount of these high expected returns, even though it doesn't appear to be super undervalued, and that's the explanation why, is that it has larger amounts of expected returns that come from its geographic risk of being focused specifically on Colombia. For better or for worse, that just is what it is. Still looks like it's a possibly attractive company. And like I said, because I know viewers of the channel are interested in, at least one particular viewer of the channel is. And I mean, like I said, myself, I am somewhat interested in the company as well. If it did manage to take a pullback maybe to the 25th percentile, maybe I would take a snag at that particular one. Now for Baytex, however, I will say, and I didn't actually mention it for Cord Energy is focused primarily on Texas. In terms of like where its geographic focus is. Baytex Energy has a little bit of a split focus of its assets on both Canada as well as Texas. So it's a little bit of a mixture between the two. And Baytex is also a Canadian company itself, like Parex Resources is as well. But Baytex appears to be the most undervalued in terms of the actual predictions I made. And like I said, the estimates for production levels I made were more based off of historical averages of its recent past, and not necessarily based off of a huge growth expectations like I had to do with Parex. While I did actually have large expectations for Parex's growth, I actually feel reasonably confident in them. So the point is who knows? Maybe Baytex actually has larger production growth ahead of it than I estimated in here, and so maybe I'm even underestimating a little bit on this one. But nonetheless, between the three, I am actually somewhat tempted to maybe take a small position in Baytex. Not to mention, it also happens to be extremely cheaply priced, so it means that I can definitely edge into the position at a relatively smaller increments, which might make it a little bit easier to make that decision. So let's see. I saw a couple of you guys make comments about Baytex. Yeah, wow, Baytex was over $60 a few years ago. Now $3. Yikes. Yeah, massive dilution. You nailed it on the head. Which is a little bit gross to look at. It's definitely one of those things where you're looking at it and you're like, oh my gosh, is that a huge problem? What I would say, it's like if you look at the exact scenario that they were in, it sort of makes sense given the debt dynamics that they were in, as well as the energy prices dynamics that we were going in at that time frame. So while it looks terrible on a chart, I don't necessarily think it's likely to repeat, is kind of the perspective I took on it. And that's also one of the reasons that I took a little bit more of a conservative approach for this one in terms of my production assumptions, because I didn't necessarily want to assume that they were going to be growing to the moon necessarily, given their lack of careful management in the past. But it does look like it's being managed in a very, very different way, much more different capital structure and different financial setup than they had back in that point in time. So I feel a little bit better about that than it does. But yeah, that massive dilution is what it is. They made some huge acquisitions basically at a point in time when the energy prices were basically about to collapse, giving them basically a huge dip in their overall equity value. How is this oil cycle not ready to revert back to the mean? BTE was negative EBIT for years. Now they've had 2 plus R12 positive. Is that just the first inning? Maybe. It's hard to say. I'm not 100% sure what you mean in terms of reverting back to the mean. Like which direction specifically are you referring to for that? Because like what I would say is that like it all comes down to like what assets they have. If you look specifically on like BTE, a lot of the negative numbers that they had for those historic years is them slowly impairing off their assets. So they're getting rid of basically all of the bad investments that they made during the previous cycle. So that's one of the reasons why I don't necessarily think it's super repeatable, assuming that they're not just going to make a bunch more acquisitions and stuff, which I generally don't think they're going to. I may have missed the company criteria, but have you looked at offshore rigging companies? I didn't look too much at them super specifically. but a couple of them were in the general pile of the general screen that I was doing initially. Though obviously none of them made it to the final 18 or so that I made the graph for. But there was some oil rig companies in kind of the larger selection of list, but it looks like none of them really made it through. And then, by the way, Mr. Beast, this down here is the list of a few other companies that I had pulled aside. Like this was some of the coal companies, and these were some of the uranium companies that had shown up. So gonna be taking a look at some of those, Mr. Beast. I promise. I promise. Yeah. I just mean I wouldn't buying it at the bottom when it was EBITDA negative have been the right time to buy. Now they're printing money again. Isn't it too late? I never know how to catch companies at the bottom by looking at them performing poorly. Just trying to see if it's too late or early mean reversion for BT. Gotcha. I understand what you mean. Well, that's what I would say about that is that well, as I was saying, that the what happened to their EBITs was heavily driven by the energy prices at the time. So it's like they were making large investments in other companies and other acquisitions when the energy prices were high, and then when the energy prices crashed, that meant that they had to write off all of those bad investments, and that gave them those horrible margins for many years. So what I would say is like it all comes down to where you think the energy prices are going, which is why we began this entire discussion with a larger forward perspective on where I think energy prices are going to go. So it's like, this is my perspective. 10 years from now, this is my perspective. Could it make a larger dip in the short run, like the regression model kind of indicated, even though, like I said, that doesn't necessarily mean anything, but who knows? Maybe we should assume this. Maybe we should assume that by 2025, energy prices could be at $50 a barrel, but then by 2030, it could be back at closer to 100. Maybe that's probably the safe assumption to make. I don't know. But the point is you should probably assume that there's going to be pain along the way within this industry. I think no matter what, you shouldn't get into the energy markets thinking that you're picking the bottom. That's probably definitely not the safe case. But I don't know. All I can say is I think that based off of the way the finances look in the historic history, that it just makes it look like those were a result of bad investment decisions. So as long as I'm not seeing continuing bad investment decisions, then I don't have a huge problem. If I saw Baytex going out, making a bunch of larger acquisitions when the prices were at really high points, then I would be concerned. But we don't really have prices at super high points right now. Some of the energy companies are at high points, but I'm talking about the energy prices themselves, oil prices and and natural gas prices. Like oil prices are at 70. 70 is not that high. Not relative to the averages it's been at, as we were just talking about. If we come over to the fundamental model, is like the average 10-year average oil price is around $66 at the end of 2022. The 10-year average oil price is around $66. So saying that we're at 70 right now, which is the spot price, not the 10-year average, we're a little bit above the 10-year average. It's a 10-year average. So you would think that you're always generally a little bit above the 10-year average, or at least a lot of the time. Obviously, if you look back at the chart, there's plenty of time frames where you're below the 10-year average, but only for so much time. You spend more time above the 10-year average than below it if the 10-year average is moving upwards. That's just how averages work. So I don't know. What I would say about energy is go into it slow. That's all I would say about it, is that you're not going to be able to predict the energy prices to perfection. I'm predicting where I think energy prices are going in a terminal basis, but I can't say anything about what's going to happen in the short run. It's possible that we have some crazy calamity happen again, and maybe we have negative negative future prices again. Who knows? But 10 years out in kind of a terminal basis, in a longer term basis, I see it more in the 80 to 90 range for crude specifically. And then I think natural gas will probably be a function of crude. And as I said, this is kind of the start of the stream, I didn't make a prediction for natural gas specifically, but I probably will at some point here in the near future. Yep, I've got small positions in Oxy and UNTC, mainly dividends, and as safe as I get in an industry I hate. Yeah, there you go. That's I guess a way to look at it. And in terms of returns for these three companies, I'll kind of point that out as well. They kind of all have a little bit of a different setup for them. Chord Energy appears to pay pretty significant dividends and buybacks. Basically, the vast majority of the returns they're shoveling out the door, large dividends. They have like a regular dividend, including a special dividend, that they also have opportunistic buybacks on top of that. Parex Resources has a regular dividend that is growing, and then it looks like Baytex Energy was actually just about to start a dividend themselves. So that could be interesting. Man, I'm dying to learn about your Schwab buy. Well, what do you mean? What about it? What do you want to know? It's like you say learn about my Schwab buy. I mean, I made a Schwab buy. What about it? Do you mean like what are kind of my longer term perspectives on the industry, and what specifically? Give me. Because I will say I talked about this one quite a lot with well invested in the Discord. Oh, which what do I got there? 10% on value amidst all the regional collapses and other similar managers. Why them? It comes down to just pricing. This is more of a midterm kind of valuation, not necessarily like a super longer term like theme based perspective. I don't really actually I'm not super bullish on the industry in general. I just think that Schwab is a stronger player within their industry, and I see them possibly as getting some benefit at the expense of some of the weaker players, depending on what happens in the space. I've kind of been a little bit vocal about like with the shifts in the demographics and the shifts in the retirements expectations. My expectations about capital markets in particular is that debt markets are going to do really well over the next decade, which is why I'm very interested like in annuities and stuff like that, because that kind of works with more debt focused markets. But I'm actually a little bit bearish on equity markets in particular. So equity market operators I'm not necessarily super bullish on, but Schwab is a very strong player. A lot of people consider them as having a strong moat. My definitions of moats is a little bit tricky, so I kind of go back and forth on whether or not I like to consider them having a super strong moat. But they're moat-ish at minimum. they're pretty in terms of their industry. I just don't know how well I think that industry in general can have a moat. But if anybody's gonna have a moat in that industry, they have a good one. So it's like I look at them as maybe while some of the other asset managers maybe lose some of their business due to equity markets having trouble, I can see Schwab maybe as being a safer player, a person that was kind of like a last resort choice to a certain extent. And I just saw them as super cheap. I looked at their multiples against their peers. I thought they were super cheap. I thought the valuation was super cheap, and so I was hopping into it a little bit. And also some of the other short-term dynamics, some of the volume metrics and the pricing metrics made it seem appealing. Some of the insiders activity as well. So I just was like, you know what, the returns look good enough, and also some of the more longer term thematic evaluations that I have weren't as attractive at the time, and I wanted to put more capital to work. So I was just like, you know what, maybe we'll put a little bit of money into some Schwab. But I would probably also pretty quickly hop out of it too if I got gains that I wanted on it. Definitely isn't something that I have some longer term commitment to in terms of really seeing some huge growth for them in particular or something. That makes a lot of sense. I thought there were a few warts on their balance sheet specifically around some of their debts that I didn't like, but you're right. It's a number one brand in a big industry. Yeah, basically. It's just like I was just like, you know what? Why not? Let's just take a small little slice to some Schwab. And like, because I don't know, I've somewhat been shifting my perspective on my portfolio. I was like comparative to the kind of management approaches I was using over the last year and the year before that. I still want to have significant concentration on a few bigger players within the portfolio, but I am trying to maybe stretch out the tail a little bit and have a larger amount of smaller positions. Not because I necessarily just want to have a whole bunch of smaller positions, but because I want to kind of feel less pressured to put more money concentrated into the other bigger positions. I kind of want to have more options, so to speak, of ones that I've already kind of paying attention to. And so I was like, let's just we'll have it's like tester positions. I want to have more tester positions. I did this with Medical Properties Trust. I did this with Schwab, and I very well might do it with Baytex as well. So we'll see what happens there. You know, I'm looking at Baytex and Parex, and kind of going back and forth between the two. As I said, Baytex is very much focused on North America, so that's one of the reasons. Even though yes, there's some of the dilution concerns look ugly on a chart, but these forward returns are more of what I'm concerned about. I worry about the future more than I worry about the past. So it's one of those things where it's like, I don't know, I might take a tester position in Baytex too. We'll see about that. So let's see. That's pretty much all of the coverage on the energy market stuff that I wanted to talk about. And we kind of talked about a few of the other companies and tickers already. So at this point, we can just kind of turn the discussion towards talking about other tickers if people want to bring some other ones up. I do technically have also the presentations for each of those companies. So if anybody wanted to look more closely at one of those three companies, we could look at some of those details. But I also have looked at those companies all week, so I don't necessarily have to if you guys don't want to. Let's see. Oh, Generac has been on a tear too. Yeah, man, I hate looking at Generac now. Man, I should have pulled the trigger. I should have just hopped on it at 125, but got a little greedy on my one in the starter position. But even though I felt like I was super conservative in the model that I built for them, I just saw them as a very, very cyclical brand. So I was still very concerned that maybe their perspective on just how much the inventories had actually cleared was maybe a little bit overdone, and that maybe they could still have a quarter or two pullback. But then, basically as soon as I was having those thoughts about it, we basically have just had like headline after headline after headline about storms and hurricanes and floods and fires and like everything else in the world that gives people uncertainty when it comes to weather and stuff like that. So yeah, Generac has just been going on one all the way up to almost 150 now, it looks like. So yeah, pretty crazy. I wish I'd pulled the trigger on that one, but oh well. That's one of the reasons we decided to quickly hop on the in mode trade as soon as we decided that it was a satisfying position. ATKR, yeah, I mean, that's another one that maybe I should have hopped on kind of relatively initially, although it's had its ups and downs, but I had my eye on it when it was at some of its lower points. So it's one of those ones where it's like, maybe I shouldn't have been as greedy. We'll see. Not sure what's up there, but I'm liking it. Yeah, that's definitely one way to look at it. So any other tickers in particular you guys want to take a look at in particular? As I was saying, this is kind of a first run in terms of commodity pricing. I'm planning to kind of take this approach and apply it to many other commodities down the road. So I'll probably be doing somewhat of a similar type presentation in other industries as we go. I obviously covered the lumber industry a little bit, and we did do a little bit of a show talking about the pricing dynamics in the lumber industry and the copper industry as well a little bit, but I am going to kind of basically do over a little bit of those again, so that I can build a more fundamental and statistical based model for lumber and for gold, and ideally, like I said, natural gas as well. And maybe if I find time, we'll also get around to like silver or something like that. And then yeah, like I said, I am interested in uranium markets as well, but I'm not 100% sure necessarily how robust of a model I can build for uranium. I don't know. I feel like that one might be a little bit smaller and less liquid of a market to find stronger correlations, but who knows? Maybe I'm totally wrong. Maybe it'll end up actually being easier for a little bit more of a niche market, or at least currently so. So we'll see. CCJ. What was the other one? I think IPOOF is too small a market cap for your screen, but they're a nice Canadian play. Well, we'll go take a look at them. In play oil. Let's see what they are at least. I'm curious. Yeah, they're very small. 166 million, 191 enterprise value. Yeah, extraordinarily small. Definitely too small for me, probably. But could be an interesting company. Calgary, Canada, and all that. Let's take a look at some of their financials. So they've gone from 25 million in revenue up to 200 million in revenue in like 6 years. That's pretty impressive. Largely negative margins that have turned around in the last couple years as well. Kind of looks somewhat similar. Yeah, I see your CCJ. Don't worry, Mr. Beast. We'll get that one next. So they're doing payouts. Looks like they started doing some payouts recently. Okay. Coming over to cash flow, let's see. Cash flow is also turning positive in the last couple of years a little bit. Cash from operations is positive across the board. That's a little bit better. So cash from investing is perhaps just a little bit higher than the operations cash flow for a lot of these years, and that's the kind of the netted difference there. So they required some financing. They were doing some debt financing, a little bit of stock issuance back in the first few years, a little bit more stock issuance in the last few years, but it looks like it's getting smaller numbers as well. What was the weighted shares outstanding? Yeah, so they've definitely issued a bunch, but you can see the huge amount of their issuance happened in the first year of this kind of 6-year period is initially, but then they were kind of in the 60s for a long time, up to the 70s, 90s. In 2022, coming over to the cash flow statement, let's see, 2022, did they do like a, let's see, they were doing some acquisitions along the way here, but it doesn't look like they did one in 2022, so that might have just been some issuance for the sake of staying alive or something. Hard to say. Balance sheet, interesting, it's not really showing cash and equivalents for the rest of the years here. I wonder what's going on with that. Maybe Ticker's just not importing correctly. Mr. Beast is owning URA and CCG. Okay, so CCG is one of the uranium ones you're talking about. Have we looked at that one before? I couldn't remember. Either way, I'll pull it up in a second. Much less liabilities than their assets, so at least they're well capitalized in that regard. Retained earnings is coming closer to the positive territory. That's a good sign. Yeah, how about valuation? Probably non-existent for a lot of the time frame, but we'll try. We'll try our best. Yeah, super negative for all of this territory, but it was positive for the other one. Which one's in the black? PE. Okay, so at least our forward PE was something normal to look at. So average PE of 4. They're trading at their kind of average PE now, but it's also only over like 2 to 3 years, so not really a super great. And we would have to compare them against their peers. But it's worth noting, we can come over to the screens that we had here and we can take a look at the peers. You know, we have peer groups right here. So like, you know, a mean forward PE would be about 13 for this particular group of like 90 companies or so. Forward EV enterprise value 13. If we're looking at a more selected group of companies, it might be like a 10 or a 7, and these are cheaper companies. So okay, so yeah, looks like an interesting company. Yeah, a little bit too small for me, my guy. But it's at least not a total basket case, I'll say that. Looks like it has some revenue growth expected in the near term, though it's going to get a huge pullback on that in the year afterwards. There's only one analyst making that pullback assumption though, when it's 3 making this year and 2 making next year. So maybe when the other guys wake up and make their estimate, they'll disagree with that guy. It's hard to say. But yeah, I don't know. At least it looks like it could be a reasonably stable company. So let's go take a look at CCG or CCJ. Exploration development of coal resources in the United States. Miller Coal, Shell Creek Coal Projects. Powder River Basin owns a small parcel of freehold land consisting of 25 lot subdivisions. I thought you were saying that this was a uranium play, or you were just saying you wanted me to look at it. Okay, whatever. Mr. Beast, on your phone, you can do it. It just doesn't show you that it did it. You kind of just have to just type it as is, and they will see it as you tagging them. It just doesn't show it to you that you tagged them, but they will see that you tagged them as long as you type it correctly. It's like I said, like I'm in people's chats on my phone plenty, so I know how it works. It's hard to tell that you did it correctly because, like, in fact, you can't even really tell if you did it correctly at all. The only way you'll really be able to tell is if they respond to you, basically. But it is what it is. CCJ looks okay, mild dilution, turning positive on EBIT, but the price is rising faster than their earnings. Oh, well, we'll see. Maybe their future growth rates are rising faster than their prices. You know, that would be the thing that would justify that, of course. But you know, maybe not. We'll see. Yeah, cool. Let's take a look at the financials. Oh, what's going on here? Looks like Ticker's screwing up the import here. Doesn't even have any revenues. Doesn't, or do they just not have revenues? Is that what is it totally in expiration right now or something? Normally it would still list the line there. Expiration and development. Do they not have any is this an error? Yeah, I mean, luckily, my chat isn't like, some super zoomy screen yet at this point. So luckily it's usually only a handful of you guys, so it shouldn't be too hard to keep track of each other. Unlike like the big YouTubers, if they have like 100 people, 1,000 people or something, then your comment goes in and it disappears like 1 second later, so it's hard to tell. I don't know if this is just coming in incorrectly or what. Maybe if I look on a different website, it'll not be screwing up or something. I don't know. Yeah, okay, so it looks like, oh, were you talking about Kamiko, or were you talking about the one I pulled up? Oh, okay, yeah, see, that's the thing. I'm like looking at this, I'm like, what's going on here? Okay. Yeah, okay, maybe. That's what I was looking at this. I'm like, what's going on? Because whatever that company was that I had pulled up there, it looked like it didn't even have revenues. And I don't know if that was an error on Ticker's part or if that was accurate or whatever. I was like, what's going on here? I was like, it didn't seem right because Jeff was saying that they had earnings. So that's why I was like, it was like, based off of Jeff's comments, it sounded like they had earnings. But yeah, okay, so let's take a look at this. So it looks like the revenue's been going through some serious shaky territory. But this is the one that you were saying is a uranium play though. Yeah. So that could be, that could be fine. That might just be what it is. Uranium and fuel services, mining, milling, purchase, and sale of uranium. Fuel services engaged in the refining, conversion, fabrication of uranium concentrates, as well as purchase and sale of conversion services. Americas, Europe, and Asia. Okay. 13.5 billion, 12.5 billion enterprise value. So it's cheaper on enterprise value. That's cool. Too busy sending heart emojis. Yeah, we appreciate the heart emojis, boys. I also appreciate the likes. I see you guys have been pumping them. I haven't even asked. Thank you. I'll say for anybody who's watching on the replay, please like the channel if you really like the content. It really helps us, really attracts more viewers. Subscribe to the channel if you're not already. Make sure you join the Discord. The free Discord is linked in the description below. Come join and be part of the daily discussions. We have what's going on in the markets. You also would have gotten a message notifying you that I was going live. I also post my videos there. And like I said, we talk about all sorts of things every day, what's going on in the markets. So come join us there. Also, there are links that you can go to if you want to support the channel in whichever way you want to as well. So that is your prerogative. So yeah, taking a look at this. Let's take a look at their financials. So yeah, so they turned the corner a little bit in 2022 finally, but there has been definitely a lot of more turning the corner in general across a lot of the uranium companies I know. You can see the gross margins while going through that kind of period of decline. We'll see. It looks like they did manage to do relatively well in sustaining the margins. It looks like it wasn't necessarily coming at their unit cost too dramatically until about 2019, 2020, but then it looks like maybe they're starting to revert back to the mean in terms of that. But so that's pretty good for them that they can go through that much revenue decline and still maintain a lot of these kind of mid 30s most of the time. That's pretty decent. Good cost management. Come down, we'll go over to the ratio page. Take a look at the EBITs relative to that, also maintaining pretty good strength. Low point of 8.5%, another low point of 3.7, 3.8%. Looks pretty good. Return on assets. Get rid of the gross margins. Much lower return on assets, but perhaps not unexpected considering they had to have a whole lot of lowering of revenues. They probably made larger capital investments, I imagine, that got them those revenues in the first place. So that means they're probably sitting on a bunch of undepreciated capital. In fact, let's just come over to the cash flow statement. Depreciation levels. Actually, depreciation levels relative to their capex. Actually, remember their capex is for most of these years a lot lower than the depreciation levels, interestingly enough. that would generally bode well for their cash flow levels. But then let's see, working capital changeovers. No, that doesn't necessarily make a huge dip in it either. I mean, what are they saying about the free cash flow? Yeah, yeah, that's sort of what I would expect. It's like the free cash flows end up looking pretty okay. Um, Obviously had some higher points in the past, but if you kind of maybe take like a rolling average between it, free cash flow margins. Actually, once more, just in case it got lost in the chat. H Cuppy, Google him, has the original uranium squeeze play. He was a tanker guy too. He's invested in Sprott Uranium Physical Trust for it. Yeah, maybe take a look at that. What do you do for your main job / career? I am currently a full-time student, getting my bachelor's in finance. So I have a part-time job stocking at Walmart as well, but that's like 1 day a week. So primarily a student for the time being. Before I was a full-time student, I worked in manufacturing. So that's pretty much my work experience and career. Me too. Awesome. Nice. BA at FSU. I am at ASU. Yeah, 1 more year to go. 1 more year until I finish my bachelor's, and then we will be back to the workforce. Be good stuff. Unless, of course, you know, my channel decides to take off and I become a full-time YouTuber. That would be cool too, or something. But you know, that's also back to the workforce, right? That counts, right? Yeah, probably if that happens, it would probably be after a few years working, I would imagine, or something. But I don't know. The goal is to, you know, maybe go get my CPA, and then we'll see from there. We'll see what happens with it. Yeah, thanks all y'all. Super appreciated. Yeah, so let's go take a look at the balance sheet, and then we'll take a look at their pricing. You were saying that the pricing is kind of rising, and like their cash flows look pretty good relative to those previous margins. So I can kind of see it. It kind of looks like their cash conversion has been improving. I'll have to go over the ratios and see if my that's kind of my intuition, is that it looks like their cash conversion is improving a bit. Maybe I'm wrong about that. See, total cash levels, they're really starting to pile up the cash and investments. I don't know if that was coming from raising capital or not, but that's pretty interesting. Payables, current liabilities versus the total current assets. Yeah, so they now have more current assets than their total liabilities. They're on net. That's pretty awesome. Not in terms of the market cap, obviously. They're not priced to net, but they have a net value. That's cool. So yeah, increase in the share price. So they did do some issuance there. Sort of what I expected. What was the... Yeah, I can see big ol' issuance, which maybe they have some serious plans on where that's going to work. Maybe there's an acquisition in play or something. I don't know. Looks like we have some serious growth expected. So yeah. Actually, let's go back over there. What was the EBIT expectations? Like, people are expecting some mid-20s margins for the next few years. That's pretty up there. Fiscal year December 22 was their first EBIT positive year in a while. 11 billion market cap. Now it's 17 billion. Yeah, well, I mean, it's the thing, is like maybe it's the first pop in a while, and so people are really expecting those margins to jump for a while. So it's the thing, it's like, look, yeah, they jumped to positive, and then they're expecting 16% the year after that, and they're expecting 24 to 25% for the next years after that. You know? So yeah, I don't know. Like I said, this could be totally wrong, but the way I look at commodity companies, Jeff, in general, and then this would kind of apply to what we were talking about with Baytex as well. It's like, with commodity companies, more than every other company, do I really think looking at the whole aggregated margin across like 11 to 15 years is actually super worth looking at. You know, it's like, look at what is their total profits against their total revenues, and like really look at it, because like the cyclical nature of their margins is more true in commodities than it is in pretty much every other industry, where you really will see like negative 10% margins and then positive 25% margins the year after that. You know, it's like, that's just so typical. So that's the thing, is like, looking at this is like, yeah, it's reasonable to look at this and be like, this has to revert, but maybe it was this that had to revert, you know? That's the thing. It's tricky that when you look at this, is like the midpoint between all this is probably the truth. So like find the lowest point, find the highest point, take an average between that. Maybe 7 to 8% is kind of like a real longer term midpoint average. I don't know. Like you said, is like maybe taking an actual look at their unit costs, taking a look at their actual production helps too. Taking a look at comparable players and what they have to do could help make a difference on that as well. But it can be tricky. So it's like, yeah, I definitely would be super skeptical of sustaining 25% margins into terminal years. But for the first 5 years, maybe. And then maybe for 5 years after that, they come down to like 0% margins. And then in the terminal year, they're like 15%, something like that. What job are you trying to land after college? Thoughts on an MBA? We'll see about the MBA. I'm returning to college. I'm 31. So this is, a late graduation for me. So my perspective on college is that I kind of want to get back to the workforce and then pay off the debt that I accrued to get my degree. So while I would like an MBA, I don't really want to accrue more debt to get an MBA. So if a company that I go work for wants to pay for my MBA and wants to push me to get one, then I will happily go get my MBA. Because I feel more than confident that I could get one. But it's not like I feel like it's too hard or anything. But I don't really want to double up on my debt levels in order to go up to that degree level. That's kind of my perspective on that. And as far as like the type of jobs, I'm pretty open as far as the type of jobs that I'm willing to do. But as I just said, I'm not looking to pay for an MBA myself. So that also somewhat limits me, since a lot of people like the MBA as kind of like a cornerstone in this kind of career in general. So that will limit the job pool for me to a certain extent, but I want to kind of get right to work. As I was saying, I am somewhat interested in perhaps getting a CPA. So then maybe I can pursue a variety of accounting jobs and stuff like that. Because yeah, I want to go into, I'm getting a finance degree. I like the finance field. I want to get a finance based job, but I'm not really looking to go into like a lot of the more hyper competitive finance fields where you're expected to work like crazy hours and stuff like that. Because I'm already in my 30s, I'm not really trying to do that to a certain extent. It's like I like to work hard, but not that hard, sort of thing. So we'll see. Yeah, I'm gonna be a poker player. What Mr. Beast said. I understand. All right. Yeah. Thank you. Uh, how about you? How about you? Are you what are you looking to do? Maybe you're a bit on the younger side. I don't know what your situation is, so maybe the world's a little bit more of your oyster. I don't know. So anyway, let's go take a look at the pricing. Then we'll probably be calling it a day or something. Ooh, yeah, whole lot of mess back here. So if we zoom past the negative multiple time frames, go back into kind of normal territory, we still have positives in the thousands, which is a huge skew. Let's get it down to kind of maybe in the hundreds. That's a little bit more appreciable. Still a little bit weirdly skewed. Let's maybe pull it back a little bit further still. So from 2013 to 2019, we have a little bit more of a normalized range. Oh, why is he a bot? He's not a bot. It's a bot. It's a restream bot that's basically taking the message that he's sending on Twitch and sending it back to the YouTube. Because I stream on YouTube and Twitch and Twitter and Facebook all simultaneously. So whenever anybody messages in any of those reciprocal chats, I have a bot that then takes that message and sends it to the other chats so that all of you guys can talk to each other no matter what platform you're actually on and watching me from. So that's why when he sends a message, you'll look at it, it says restream bot, but then it says Twitch, and then it tells you his name. So it tells you that he's on Twitch and he's messaging me. Yeah, so it's a neat little thing that I have implemented in my stream, which I don't know how much longer I'll necessarily do that for. It's worth noting because I don't know, some of the streaming services are making it a little bit more of a pain for people to stream between. Like I know Twitch in particular is changing the rules around a bunch. So Twitch might make it impossible for me to do that actually in the near future. I don't know. We'll see about that. So what was that last comment though? I'm 22, thinking about an MBA, running an ecom store at the moment and just starting my junior year at uni. Not sure the exact position I'm looking for, but I enjoy the field and like to make money. Yeah, there you go. Well, yeah, 22, definitely a lot more time under your belt. You could definitely the present value of the future earnings from your MBA would make a large enough dent in the debt that would make a big difference. Yeah, so an MBA is definitely worth thinking about for sure. It all and then you working an e-com store yourself as well. That's pretty cool. So best of luck with that. I hope that all those things work out for you. Ah, is that why your YT stream starts while you're talking already sometimes? Good job, my man. I'm running in the morning. Yeah, that might be the case. I wasn't necessarily sure how much of a delay that it has on that process, but that might be the case. Yeah, because my streaming software sends the stream to restream, and then restream sends it to the various streaming services. Yeah, so there's probably is like a small lag there when it starts up the process, which I have the streaming settings to make it so that the latency is as low as possible, but there is, yeah, this kind of extra layer in between created by that, which it's cool, but it is what it is. And the restream send to the moon. Yeah. So yeah, looking at this pricing though, so like during 2013, 2019, you can see that they were very richly valued. Oops, sorry. They were very richly valued, but kind of within somewhat of a normal band of richness, kind of moving upward into the upper levels. And this is kind of when they were moving into some of those really negative territories. So they were doing large amounts of reinvestment, and it looks like the market was really appreciating them, or at least not overly punishing them for it. Then they went to the super negative territory, which is, we can't really look at that. The multiples start to be meaningless. If we kind of try to zoom past a lot of that mess into maybe the more normal, more recent time frame, a little bit, and you can see that we had some upper level pricings, and then this has really come down in the last year or two. So yeah, they're still up at very high multiples, I would argue. But if you're kind of can take it into account relative to the previous high levels of multiples they've had in the past, I would say that the market is just kind of maybe appreciating the growth that they're expected to have, especially considering that, I mean, that growth really is expected. I didn't see how many analysts did they have for these projections? 5. That's pretty good. So it's a handful of people that are making these projections. So that might be reasonably solid. As we were talking about, the real question is how much of it they can capture on the EBIT, and then the real question is whether or not they're going to squander those cash flows. So we'll see about that. Jeff's leaving. All right, guys, got to run. Love to see the channel grow. I'll see you next time, Jeff. Always appreciate you. Yeah, and as I was saying, I'm pretty much going to close up here in a second anyway. It's just kind of trying to finish discussing a little bit of this company for Mr. Beast. But yeah, so I mean, we'll definitely come over to the valuation dashboard, taking a look at like what we're expecting for this week. Like I said, I'm not sure of the companies that we currently have in the value dashboard. A lot of the ones that are the most appealing to buy, I really have already very solid positions on. That's kind of locked me away from buying more of them. I really would like to maybe buy more Hibbett, but I already have a pretty solid position in that. Same with Smith&Wesson. I kind of want to buy more FG, maybe on a pullback, but maybe not at the current levels. And then maybe I'll add more InMode because I've been buying that more recently. And then as I was talking about earlier, what with the kind of analysis that I did here this week, I'm very interested in maybe taking a position in Baytex or maybe Parex, maybe both. We'll see about that. I don't know, but we'll see. But all right, so I will say one more time before I go, if you're watching on the replay, please like the stream, please subscribe to the channel, maybe visit the Discord. The link is in the description below. It's free for all who join. Maybe CCJ, as Mr. B says. We'll see about that. But we'll definitely be taking a look at the uranium space at some point in the near future. But all right, I'll catch you all in the next time. Bye.